Hey guys, we are here with another episode of the Texas Blockcast. I am joined by Jamie McAvity, the CEO of Cormint. Jamie is a longtime member of the TBC, and they've done great things here in Texas. We're going to get into a lot of stuff about their operation and some really unique components about Cormint related to curtailment and software. But before we do, Jamie, how are you doing? And yeah, just what's your sentiment today? Like, how are you feeling?
I'm feeling great. I'm in New York City right now for the mainnet conference. There's a lot of Bitcoin and crypto industry people here right now. I'm actually coming to you live from PubKey. I'm in the upstairs co-working space at PubKey. I'm going to give a little plug to Thomas and the whole PubKey team. So PubKey is a bar in Greenwich Village, right next to Washington Square Park, and it is a bar. They have food, but the name is a twist on public key, Bitcoin public keys. So it's called PubKey, and it's a
Nice.
Bitcoin themed, Bitcoin focused bar. So Cormint has a meetup here tonight where we're going to be talking a little bit about our business to the Bitcoin community. There's going to be lots of Bitcoin people in town coming to the bar tonight, coming to the meetup. I'm meeting a couple other Texas folks at the bar actually right after the podcast. So next time you're in New York, come check out PubKey. Thomas has built a really great Bitcoin community here, and it's always good to get away from shouting at each other on the internet and get in person, and maybe we have a lot more in common than we all feel like we do sometimes when we're tweeting away on the internet at each other. So that's my PubKey shill. I'm in a great mood, very happy to be here. And Lee, can't express our gratitude for your work and TBC. You're doing amazing things, and I think you got a bright future in the state of Texas, and you're really helping the mining industry to plant a flag there. So we're big supporters and big fans, and really grateful to be on the show with you today.
Awesome. Well, Jamie, I appreciate you guys' support of us as well. And before we pat each other on the back too much, let's jump into the conversation today. And I should actually say we are going to be patting you on the back a little bit more, because let's just start out with this. Cormint, from what we have seen and what the data that we have reviewed, this is data coming from ERCOT, has been the most proficient curtailer of energy of any large flexible load in the state of Texas. And let me break that down for the audience. That means that when the price of power increases, and you would expect to see the most economical curtailment of use of power, and sort of watching those two things as if they were on a line graph, Cormint is almost inversely correlated with the price of power. So their power consumption habits are inversely correlated with the price of power going up, which is interesting because everybody's trying to do that, and everyone does that to some extent. But it's interesting that we're actually able to see Cormint be the number one curtailer of power. How did you do it? Maybe don't
Um,
spill all the beans, not anything proprietary, but that's a pretty impressive thing to have happen.
Sure, yeah. We had no idea that we were number one, and it was a surprise to us when we were told that. We didn't even know that data was being collected. The way that ERCOT figured it out was kind of interesting. They basically did a perfect economic simulation of a Bitcoin miner with a profit maximization strategy, meaning you're only consuming a kilowatt or a megawatt hour of electricity when the Bitcoin-denominated value of it is higher than the power cost. And in a marketplace like ERCOT, it is very tricky to do that. And we were not perfect at the beginning, but we've been studying this market for a long time, and so we've continued to iterate on our curtailment capabilities. And yeah, it was really an honor to be told that by ERCOT that we were number one. And I gotta give credit to my amazing team, our software developers, and our power market folks. It takes a big team effort to execute and to deliver a good result. And so, I can't really take credit. Just got to say, I'm really proud of our team, and yeah.
Well, it is impressive, and it was observed by, is his name Anthony Powers, the analyst that puts out information. So you guys recently, y'all are not publicly traded, but you recently came on that list as the lowest cost of production miner in the world.
Yeah. Again, another surprise. I spent an afternoon chatting with Anthony from my trailer out at our mine in Fort Stockton, and it was a great conversation. We talked for an hour and a half, and then I just sent over our results, our financial results from the first half of the year, and then 24 hours later, he published this amazing graph that showed that our electricity gross margin and cost to produce a Bitcoin was number one amongst all of the companies who reported worldwide. So it was a big honor, and it was a great day at Cormint. The team was really fired up to be number one there, even though we're relatively small compared to all the other companies who reported.
It's exciting, and it makes sense that would happen in Texas, right? And there it is possible, just for the listeners, it is possible that somebody somewhere has, is stealing power and getting, they have 5 megawatts on and they're stealing it somehow in Russia or China or something. They have a lower cost of production. But I guess with that caveat of the miners that report data that are actually legitimate, large companies, Cormint has the lowest production cost of any miner in the world, and fitting that would be here in Texas.
Yeah, I mean, Texas is the best place to have a price sensitive load. In a lot of other electricity grids, the grid buys all of the volatility, and then they subsidize the cost out to all the participants. So your average grid has a net higher cost of power on average versus ERCOT, but has much less volatility. And in Texas, like they do with everything, and that's what makes Texas great, they let the free market do its thing, and consequently, power prices are extremely volatile. And our buddy Nathan from BP, Nathan Mancha, says takes big cojones to trade power in ERCOT, and he's absolutely right. I mean, the price of power can go from $30 to $1,000 in 1 5-minute interval. We see it all the time. Your software has to be really fast, and everything's got to be finely tuned to take in all of the variables that contribute to power cost and optimize it. And so it's a great fit for a grid like that. A grid with high volatility and a lot of intermittent renewables is a perfect fit for a Bitcoin mining load. You talk about this more than anybody, and I know we really need to beat the drum on this, but you have this free demand response, which is absorbing excess energy when there's too much renewable generation, and then shutting down when the residential communities and everybody else who really needs power cannot shut down. So you have this perfect balancing load it's an economically perfect consumer of electricity. It is only consuming when the price signal says to do so, and ERCOT lets price do a lot of the work that demand response programs and a lot of regulation do in other grids.
I've got to give you credit for that phrase. I remember you and I were on a panel at the Gulf Coast Power Association event years ago, and I heard you say economically perfect consumer of electricity. Did you? Is that yours, or did you get that from somewhere?
I got it from somewhere, and I'll give a shout out because the guy who said it is a brilliant guy. He's not even in Bitcoin anymore. He's a guy named Greg Thurnher, and he was working at Shell MP2, and I believe he moved over to Tesla. And Greg is an absolute savant about power, and we knew the characteristics of this consumption profile, economic perfection in electricity consumption, and how unique it was, just from our experience in commodity markets and power markets in general. But it was actually Greg who we heard it from. Now, I don't know if Greg stole it, but I have to give the credit to Greg for coming up with that.
That's awesome. Okay, let's talk a little bit more about this. So when you said Shell and MP2, it kind of made me think about some dynamics in the power markets here. In Texas, there's been a lot of shade thrown that consumers are not able to take advantage of demand response and other ancillary services in the same way that large industrial loads are able to. And I have gone on the record, and you have gone on the record at saying we would be supportive of consumers being able to do that. It's more of a a challenge for ERCOT to aggregate all those small meters and all. It presents a significant logistical hurdle, but I want to make sure that the audience knows that the Bitcoin mining industry is not opposed to consumers being paid for their curtailment. Now, I do think that one day we will have enough smart technology in our homes, enough smart thermostats, and because really in Texas this is AC units, right? I mean, if we could aggregate AC units and use those as demand response, I mean, that would shave off some massive volatility in power demand.
Yeah, and the heating units in the winter. Texas homes are insulated poorly because it doesn't get cold there, and that's a huge contributor to wintertime volatility. So it's
Greg or Doug Llewellyn would be glad that we were talking about this. He's always talking about this. Is it Doug? What's his last name?
Yeah, it's Doug Lewin.
Doug Lewin, excuse me. Yeah, Doug Lewin is talking about that, the insulation issue. Okay, so what do you think? It would take a statutory change, to my knowledge, for consumers to be able to do that. Why do you think Bitcoin miners are so readily, because that would take money out of miners' pockets. Less volatility equals less revenue. But why do you think that as an industry we are willing to support that?
Well, we should start by clarifying one of the most frustrating misunderstandings of the Bitcoin critical media, where whenever a miner comes out and reports, hey, we made all this money from demand response or curtailment, the reality is that in order to make that money, you have to be long that power. So you have to make an economic commitment to buy power from a counterparty, and that is not free.
Significant collateral, millions of dollars of collateral.
Millions of dollars of collateral and millions of dollars of financial risk, where if you look at the distribution of hourly interval prices in ERCOT, it ranges from negative $30 a megawatt hour up to, as we know, $5,000 a megawatt hour. And when you have a power hedge and that interval liquidates below your power hedge, you are paying up for that power during that hour. And so when there's a lot of wind, like this coming week, especially in the evenings, we have a ton of wind in the evening. So all of those Bitcoin mining companies who had power hedges through the summer and continue to have hedges for the remainder of the year, they'll actually be realizing a higher electricity price than
the spot market.
Than the spot market, than the rest of the residential consumers. And so you have to take risk, and you have to post a lot of credit in order to be able to do that and get paid to do it. Now you can just respond to prices if you're a sophisticated electricity market participant, which is what Cormint does, but we don't get paid.
Right.
We are just a real-time market consumer, and so we're just avoiding high prices when we curtail. And if you think about it, like anybody in Texas could do demand response. They could just hook up their circuit breakers in their garage to an API that's ingesting ERCOT's price feed in real time, and they could have their breakers in their house just automatically flip open when the price of power spikes above the cost that they want to pay, and that should translate through to their electricity bills. And so,
but only if they had a wholesale contract.
Well,
if they're on a retail, they'd
contract, be avoiding high prices. If they have a meter in their home, it depends on how the utility bills them. But if they had a meter in their home and they had a real-time market contract with a utility, which I don't know if you can do that in Texas, but if you were able to do that, then theoretically your meter would show that you did not have any electricity consumption in your home during a high price interval, and you should not be charged for that period of time. If you have your own substation, that is definitely the case, because that's our entire business model. We don't open breakers, we programmatically power down as much of the infrastructure on our site as possible whenever prices go high. Our normal load is about 35 megawatts, and we can bring it down to 700 kilowatts in a matter of seconds. So it's really designed to power down, and ERCOT's not paying us for demand response. We are just responding to the price signals that are a function of the market structure that they've set up.
Yeah. Okay, so I think it's interesting. Most Texas consumers, and I think after Uri, maybe all Texas consumers are on these fixed price. I've not seen an article that says retail electric provider taking advantage of Texas consumers by arbitraging, their all 30 million Texans by playing the power markets on the back end and charging all of us at 14 cents per kilowatt hour rate or whatever. We negotiate anywhere from 10 to 20 cents as consumers in Texas. So it is funny how the sensationalist headlines really miss. There's like multi-billion-dollar companies that make their money off of the fact that consumers aren't able to do this, and that's not the miners. The miners are the ones operating in such a way to do it, and these retail electric providers are the ones that play in the power markets and buy the hedges and basically arbitrage the consumer's electricity. So it's mind-boggling to me that none of that ever gets reported. But we will see more of that in the Texas legislature, more calls for consumers to be able to take advantage of their responsiveness. And who knows, with Google's Nest technology and all this stuff, it is possible that we could be going in that direction. But I digress. Back onto Bitcoin mining. What do you think about the upcoming halving? Are you, obviously, as the lowest cost producer in the world, you are quite literally the best placed miner. You will go offline the last as far as difficulty adjustments, the halving. What kind of, I guess, percentage decrease do you see coming in the difficulty adjustment when the halving hits? Do you think there will be a corresponding rise I personally think that Bitcoin's price will actually run up due to an ETF approval before April. I think we'll have a spot ETF approval before April. But what is your opinion about the difficulty drop that we might see at the halving?
Yeah, that's a great question. And it's hard to speculate about what market conditions are going to be when the halving occurs. The halving will occur sometime around next April. And what we can do is extrapolate what we believe would happen based on the data that we have and the current financial conditions, like the current economic conditions of Bitcoin mining. So currently, the average miner on the network is about 27 joules per terahash. You can probably say that when you include cooling load and ancillary load, that's probably like 28 or 29 joules per terahash. And for those machines, the current break-even price is about $70 per megawatt hour. And if difficulty rises, that break-even will go down. If the price of Bitcoin goes up, that break-even will go up. But if we were to hypothesize what the break-even would do were the halving to occur tomorrow, then the break-even for the majority of those machines would drop to $35 a megawatt hour from $70 a megawatt hour. And if you look at data that's been aggregated and published by Luxor in the past, that would make about 50% of the global mining industry unprofitable. And so certainly there would be some time while the difficulty adjustment responded to slower block times. And as blocks were found more slowly, we would get a sense of how much uptime of the existing fleets out there were reduced in response to lower profitability, and perhaps how many operations just decided to shut down altogether because they were too far away from a break even or their financial position was too weak to survive a long period of negative profitability. What will happen in ERCOT, you're going to have two different scenarios. If we just assume all of the Bitcoin miners in ERCOT have the same efficiency of fleet, which is not the case. Obviously, everybody has different machines and different cooling and different hedge contracts that exist. But let's just assume, for the sake of simplicity, that everyone's got about 28, 29 joules a terahash of efficiency on their fleet on average. And after you make that assumption, you can really separate it into two buckets. You have people who are real-time market consumers like Cormint, where we only consume power when the revenue is above what we call the Bitcoin opportunity value, which is Bitcoin mining revenue expressed in dollars per megawatt hour. So we would likely, just in our particular operations, our uptime would go down pretty significantly in response to that, where we would only be able to mine profitably if the price of power was below $35 a megawatt hour. In ERCOT, that is still about 60 or 70% of the year. So we would still be operating at a slight profit or break even that percentage of the time. That position feels really safe, feels like a really good spot to be in. If you're a real-time market consumer, if you're in West Load Zone, you benefit from the export constraint from West Texas to East Texas, not enough transmission capacity. And so those miners will be in an okay position, at least relative to their peers. The interesting thing that could happen is, since the invasion of Ukraine, forward power prices have really not been much below $45 or $50 on average. There's been some periods where you could maybe get lucky and lock in a $40 hedge for the next year, but we've seen long periods where it's $50, $60, even $70 a megawatt hour is what the forward curve of 1 year of around the clock power costs. And so if you have a hedge and your hedge goes through the halving, you don't have the luxury of curtailing in response to high prices. You have to consume that power. So that dynamic could be really interesting, and I suspect that every miner in ERCOT who has a hedge or is planning to hedge is watching the halving closely. And certainly some of the folks that we speak to who advise the different mining firms in the industry there, the halving is all over their radar. The consensus seems to be that nobody really wants to be hedged much through April, at least right now. I think it's still too far away to make a definitive decision one way or another, but it's going to be interesting. I think there's definitely going to be a significant difficulty adjustment downward. It's not going to be like it was in the last big period of sort of mining industry bear market, which was the fourth quarter of 2018. There was a 30 to 35% difficulty adjustment in November of 2018. It's a different industry now. A lot of these companies have huge balance sheets. They can withstand periods of negative profitability. But at the end of the day, I mean, numbers are numbers. And if you are producing Bitcoin at a loss, there's not a really good answer as to why you shouldn't curtail or shut off that load. If you have a PPA, I mean, you're either producing Bitcoin at a loss or you're taking a loss on your power contract for every interval that it clears below the price of your PPA, of your hedge price. So it's a tricky situation, and we'll see what happens. Texas is in a much better spot than most of the rest of the world, but it's going to be a good event for the industry in terms of only the strongest producers are going to survive. Probably the percentage of renewable energy that we're using is going to go up because renewable energy has no fuel input. So when there's large renewable output, you tend to see the lowest prices. That's the only time when you see negative prices is when it's all mostly dominated by renewables. So yeah, we're excited that it looks like we will survive it and potentially thrive through that period. And this is why Bitcoin mining is so fun, because it's such a dynamic game theory industry, and the behavior of every individual participant affects everybody else on the network. It's really fun almost an organism of sorts.
I was gonna say that it is almost like an organism. I took a game theory class during my PhD studies and was terrible at game theory, but from conceptually, like as a economist, political scientist, I love game theory. But once you get to like the number of players and the number of potential moves, and you increase that square, and the game theory gets really complex, um, that will start to blow people's mind. So I agree with everything you said. I have one bullish thing though. I think there will be an ETF approved before the halving.
Yeah.
So I
Yeah.
I tend I tend to be in the camp that says we may only see like a 15% downward difficulty adjustment, because we had corresponding in the weeks leading up, we had some price uh, rise due to an ETF
Yeah.
approval like in Q1 of 2024.
Sure. Yeah. And that's totally plausible. It's also, I mean, historically speaking, when the reduction in new issuance occurs, you do see the supply and demand reset the price equilibrium for Bitcoin. Typically that's when the bull markets have occurred. The ripping bull markets have been 12 months or so after halvings have occurred. That last halving was 2020. After that halving went from about 8,000 to 60,000. In the 2016 halving, the next year we went from 500 to 20,000. So it was exponential increases in price in response to a halving of the available new issuance. So it's an interesting thing that you could see in Texas. You have 2,000 megawatts of mining load in Texas, and there'll probably be more by the halving next year. You could just see all of the Texas firms survive with reduced uptime, maybe 50% uptime, and then the price if there is no ETF, and say normal price conditions, normal market conditions, if the price rebounds and mining break evens get back to that kind of $70 a megawatt hour level in the third and fourth quarter following the halving, then it could just be a short period of low profitability, and then everybody will be sort of fine by the fourth quarter. It is also interesting that the 3 months following the halving will be May, June, July, August. It will be the summertime periods, which typically are the periods of lowest uptime and most price sensitive curtailment for ERCOT and for all the other Northern Hemisphere jurisdictions that have high prices and hot temperatures during the summer. So it's going to be really fun to watch.
Yeah. It is. Okay, you brought up something that I have to double tap on. The Miner Mag, Nishant and his group at the Miner Mag published that data recently about the distribution of Bitcoin mining in North America. And I felt vindicated in a way, because I've been telling people for a long time that there was way more mining in Texas than people thought. And people already think that there's a lot of mining in Texas. But I would tell people, hey, we are like upwards of 40% of U.S. Bitcoin mining. And from this data that Nishant published, Texas is 54% of U.S. Bitcoin mining. Yeah. 2,260 megawatts per his numbers. I think our numbers show 2,290 megawatts, so almost identical. I think he uses mostly publicly traded data, so we're probably missing a little bit of public data, but we have some private mining data that they wouldn't have, because that's not publicly available. So anyways, about 2,300 megawatts of Bitcoin mining in Texas, 54%. Now, I did look at this, and I wonder what you thought. Do you think that there are some regions that were undercounted in that? Because I saw only 100 megawatts in North Dakota. I saw 400 megawatts in Georgia. North Carolina and South Carolina looked a little bit lower than they should have looked. Canada looked a lot lower than it should, especially Alberta. So I didn't know if you had seen it and what your thoughts were about all that.
I'm sure that it's not an accurate picture in terms of all of the numbers being perfectly correct. There are.
It's impossible, yeah.
Definitely a lot of smaller mining firms, maybe especially off-grid mining firms who are, they're probably much less inclined to report publicly on their dealings. They're generating their own power that might be co-located with oil and gas. And so I would bet, if I were going to make a guess about where it's wrong. I bet it underreports off-grid. I bet a lot of that off-grid is happening in Texas, disproportionately higher than in other jurisdictions. So I think your numbers are probably about right, that Texas is the largest North American mining jurisdiction by roughly the margin that you said, 50 to 60% feels right. And I mean, I'll just say,
Now that is of the U.S. If you do it
yeah.
of North America, we drop down to like 38,
Oh, okay.
39%. Yeah.
So including Canada, got it.
If you include Canada, yeah, we're just shy of 40% of North America, but we are just over
Sure.
50% of the U.S.
Right. Okay, that makes sense. I mean, yeah, it's the Texas-based miners are probably going to gain or maintain market share relative to their peers through the halving, because of the ability to vary uptime and only consume the extremely low price renewable dominated intervals. One thing I think that will become more obvious and more interesting through the halving is most Bitcoin miners, they're bullish. We're betting on the upside, and then you can get long power, and you can arbitrage power versus Bitcoin mining revenue. That business model is out there. Everybody really thinks about that. But I think the really interesting dynamic that will start to become more attractive is the Bitcoin mining load's ability to absorb very low price, zero and negatively priced electricity intervals for generators who are kind of stuck generating during those periods. The guys over at Satoshi Energy, this is their business model, is they help wind farms get co-locations with Bitcoin miners, and in those deals, the Bitcoin miners absorb that excess power that would normally be selling for $0 or negatively priced margins, negative margins for those generators. I think that side of Bitcoin is really interesting, especially when you think about decarbonizing the grid and all of these tax programs that incentivize renewables. I mean, solar panels, you can't buy solar panels for 2 years right now. The boom in solar is just relentless. Mm-hmm. And normally we really see most of the negative pricing occur in the evening and during periods of low demand when the wind is at its highest output. But we could start to see the proliferation and growth of solar start to drive some of those low-cost intervals during the day, during the peak times, especially in the morning when it's not
around
quite so hot.
10 a.m., 11 a.m.
Yeah, we could start to see that the same way that wind farms have eagerly greeted and welcomed Bitcoin miners into co-location schemes. The same thing could happen with solar, where solar says, hey, I need to get me some Bitcoin mining load behind my meter, and I don't want to have to deal with zero and negatively priced power. So as a company, we think the put option is just as compelling as the call option as far as electricity market interaction between Bitcoin miners and power generation. Power generation is concerned, and we think in the halving that's going to become a little bit more obvious, because now you can buy miners pretty cheaply. So if you're an energy derivatives trader and you say, okay, how much would it cost me to buy a put option for power at my wind farm or at my solar farm? If I went and priced that out with a bunch of banks, compare that cost to building a Bitcoin mining data center now, and you get a put option and you get some upside on the price of Bitcoin. I think those numbers are starting to look more favorable with Bitcoin miners trading at much lower prices relative to the last 24 months or so.
And you're saying they have like some sort of profit sharing mechanism. That's why they have some upside on the Bitcoin side?
No. So currently, at least in all the configurations that I'm aware of, there's no profit sharing between the Bitcoin mine and the wind farm. The wind farm gives substation capacity to the miner, and the miner is able to avoid the cost of building a substation, which is time consuming and expensive. And in return, the wind farm has a floor price below which they will never sell power, because they can always give that power to the Bitcoin miner, and the Bitcoin miner doesn't participate if the real-time market price clears lower than that. So
I see. Yeah, I see what you're saying.
Those are the way those schemes are currently constructed, but it could be something where a wind farm says, hey, well, we like the upside on Bitcoin here, and there's all these great service providers in Texas who can help us get containers, buy miners, software to run power, software to manage the mine, and we're just going to mine Bitcoin ourselves, and we'll consume our own power. And in that event, they would own the Bitcoin miner, they would own the actual means of production. And so if the price of Bitcoin were to go up, then they would benefit by earning more revenue, expressed in dollars per megawatt hour, and they're effectively long Bitcoin at that point.
Yeah, I think about that sometimes too, and I think, all right, they're still at a place where they're very happy to structure those deals on the power purchase side, or the behind the meter deal, or however it looks. And even though there are efficiency gains, scale gains, and just greater profitability opportunities for the generator, like say the wind generator, to own the Bitcoin mining, I think they're still kind of far away from doing that. What do you think?
Well, certainly there are a number of
Like
downsides
the really
to
big ones,
consider.
especially like the ones that have high reputational
Sure,
risk.
exactly. That's exactly where I was going, is that there are downsides to consider. Bitcoin mining firms, both in terms of getting credit for power, and raising capital, especially in fiat USD debt and equity markets, it's a tough environment because of how much investor capital was torched in the 2020, 2021, 2022 bull and bear cycle. So there's two components that I would point to there. The first one is reputational risk. If you're a VP at some energy company and you become the Bitcoin guy, and you dump 50 million of your company's capital into mining R&D and building out a bunch of stuff, and it goes bad, you're probably going to lose your job, and there's not that much upside for you. So versus a Bitcoin mining company like Cormint, we're already long Bitcoin. Our reputations are already totally tied up in this, so we don't have that to lose. We don't have something to lose that we currently have, because we're a Bitcoin focused firm. So you have the kind of reputational risk that I think would deter some people from taking that career risk for themselves and potentially risking their financial stability or their family's financial stability. Then the second component is actually from a credit cost perspective. Operation Choke Point from the Biden administration, I believe that is a real thing. I think it's well documented that firms that are associated with Bitcoin mining and any kind of crypto activity are punished in terms of their ability to access banking relationships, letters of credit, things of that nature. We have firsthand experience of, I don't want to call it discrimination, because I don't think we have a right to banking services as a company or as people in the United States. You don't have guaranteed financial access. I don't know the law that well, but
it's not a constitutional right.
It's not a constitutional right, but I do know that my personal banking relationships, our company's banking relationships, my ability to use assets that I own to come up with configurations where I can extend credit to the company just to help us with power market purchases or margin for posting to ERCOT. We have been really constrained in doing that, and I would say almost to a point of being unreasonably discriminated against by the banking industry. And I think the banking industry is responding to pressure coming from the Biden administration to not bank firms that are associated with crypto activity. I mean, Silvergate, Silicon Valley Bank, and Signature Bank were the three main crypto banking firms, and they all went bankrupt within 90 days of each other, or were taken into receivership by the FDIC, or whatever happened. I mean, it's still unclear, I think, especially in the case of Signature, whether or not they were actually even insolvent. So we're still feeling the ripple effects from those events, and I think that those two things, career risk for power market employees and executives, and the overall potential degradation of your credit rating or your credit worthiness in the eyes of counterparties if you adopt a Bitcoin strategy, that is keeping people on the sidelines for sure.
Yeah. Well, you brought up something, and this is the last question I'll ask you. The market, the capital markets. You guys have a unique strategy, and you raised a Bitcoin-denominated debt round.
Correct. Yep.
And maybe that's phrased incorrectly. Help me
No, that's
understand.
exactly right.
Okay. Help the audience understand. I know we may need to put some disclaimers on this. This is obviously not financial advice. This is just our opinions about a very unique fundraising mechanism, capital formation mechanism. Do you want to go through and talk a little bit about that mechanism?
Yeah, sure. I mean, we've loved this idea for a long time. I spent the early part of my career in a commodity, in the commodities business. I was a market maker on the floor of the New York Mercantile Exchange, which became the Chicago Mercantile Exchange. And my business was to make markets for actual physical commodity market participants. So oil drillers, oil refiners, large consumers of oil or refined products. Now, anybody who had exposure to the price of oil was coming into these futures markets to hedge some of their exposure to them. And one of the big use cases for that was, let's say I'm a large minerals owner in the Permian, and I want to go and start drilling for oil and gas, and the price of oil is $90 a barrel. I'm going to go to the bank and say, hey, I need $100 million to go and expand this drilling operation. I got these great mineral resources out there, and I've got this great company who can help me pull it out of the ground. The bank will say, that's great, we're happy to lend you the money, but you have to hedge the price of oil. If oil goes to negative like it did in COVID, then your ability to pay back your loan is obviously going to be severely impaired. So one of the most formative experiences in my commodity days was when, during the booming oil market of 2008, we actually saw a liquidation of an oil producer at the all-time highs of oil. It was about $130 a barrel. And this oil producer, who their proven reserves had never been worth more, was actually getting liquidated on their short hedges and going out of business during the all-time high of crude oil prices for that, in the history of oil. I think it touched there briefly during the Ukraine war, but I can't imagine how painful that was for that company. And
that's just because they had hedged so much that their exposure to high oil prices was. Help me understand that a little bit more.
Yeah, so this is part of the reason I'm getting to the point of why Bitcoin-denominated debt is such an elegant commodity production finance vehicle for Bitcoin miners. And I promise there's a point here, Lee.
Yeah, no, I'm tracking. I'm learning.
Yeah, so that particular oil producer had sold short a lot of oil in the futures market, and they'd used a bank to do it. They borrowed money against the future revenues, and then the bank came to them when oil was, I think they hedged at $90 a barrel, and oil went to 130, and the bank said, hey, your hedges are underwater by $40 a barrel. You need to post $1 billion in capital. And the oil company said, well, we don't have $1 billion. We have proven reserves here, and we're pulling them out of the ground, but it's going to take us a couple of years to get there. And the bank said, sorry, we don't take proven reserves as collateral for futures hedges. We owe that money to the CME. We have to post that money to the actual commodities exchange, because commodities prices are marked to market every day. You have to have the money in your account for any fluctuations in price. And the old adage, the market can stay irrational longer than you can stay liquid. That's what happened. Is you would think that it would make no sense to liquidate an oil producer on the all-time high price of oil just because they sold it a little too early. But that's exactly what happened. And that is completely avoided by having Bitcoin-denominated debt, where if, for example, the price of Bitcoin went up significantly and we borrowed Bitcoin from our lenders, and we owed them back Bitcoin, it's a term loan. It's not a mark-to-market futures position. So we owe them Bitcoin at a certain point in time in the future. We owe them interest in the meantime, and we have the term of the loan to pay that back. And it is understood that the investments that we make will produce that amount of Bitcoin and more that we owe them during the term of the loan. And so by using the actual Bitcoin as the financing currency, it is almost like if that oil producer who got liquidated actually borrowed in barrels of oil from somebody else and owed them back barrels of oil,
Right.
instead of borrowing USD and then going and selling a bunch of futures to lock in the price.
Yeah.
Um,
It is really
so
elegant.
that it's very elegant, and having seen that that extremely painful liquidation process occur for that commodity producer early in my career, I learned that lesson of, you know, the dangers of margin and the dangers of liquidation risk. And so we always sought to use Bitcoin-denominated debt in our financing structures whenever possible. It just so happened that now, you know, access to USD capital markets is relatively constrained industry-wide for Bitcoin miners, whether it's equity or debt. It's, you know, as I mentioned earlier, the destruction of investor capital in the last bear cycle has basically closed that door. And so now, in addition to being an elegant commodity production finance tool, it's also a way to access capital. It's a way to deliver yield to Bitcoiners. You know, it's an interesting product. There's not a lot of ways for Bitcoiners to earn Bitcoin-denominated yield, and it's not a taxable event too,
Oh,
which is
is the interest in Bitcoin?
the whole thing is Bitcoin-denominated, so it never touches a US dollar rail.
And it's
So,
not taxable because there's no liquidation, there's no capital gains, there's no.
well, your interest is taxable because you're receiving interest income. But as far as, like, let's say you bought Bitcoin at $1,000 a coin, and then you came and lent it to Cormint, and Bitcoin's trading $30,000 a coin, you're not realizing a capital gain on your loan there. You know,
That makes
this
sense.
is not financial advice. This is based on the research that we've done, and you know, everybody's got to do their own research and talk to their own tax advisors. But the advice was given to us that this is not a taxable event, and that as long as you lend Bitcoin and then you are paid back that same amount of Bitcoin, that's what's considered a return of principal, and that's not a taxable event.
Yeah, the logic seems really sound, although I am also not a tax advisor. So I do, uh, though, know several people that advise on this and would probably, and probably some of the same people that advised you guys on y'all's round. Was that a successful round? And what's the capital? What are you going to do with the capital? Obviously, you're going to have to liquidate that Bitcoin in the short term to expand
Yeah.
operations, right?
Yeah. I mean, it is scary, and no matter what, you know, no Bitcoiner will feel comfortable doing that. But we're producing a good amount of Bitcoin on a daily basis out there, and all of our loan proceeds go into creating the means of production to produce more Bitcoin. So,
And if you're the lowest cost producer, then there's some pretty reasonable,
right.
lines that you can chart out from there.
Yes, generally speaking, if you have a high cost of production, or you're, you know, in a hosting facility, it's a little bit more dangerous to do this. I would probably advise against that. But because we're a very low cost to produce, we have a very low cost to produce Bitcoin. We think that if there are downward difficulty adjustments, that will benefit our ability to actually service Bitcoin debt. You know, in a perverse world, the best possible trajectory for Cormint as a Bitcoin, debt holder, or having Bitcoin denominated liabilities on our balance sheet, is that the price of Bitcoin drops very severely for the first year of our loan. Mining difficulty collapses. We're earning a lot of Bitcoins at a much lower price during the first year, and then there's an inevitable rebound in the price. During those scenarios, our financial modeling kind of indicates that our ability to service those debts would be greatly increased in bear market scenarios. So it's very resilient through all of the market conditions. The condition where it performs the weakest is actually where there's really low market volatility and the market just gradually ticks up slowly over time. We've never really seen that happen in Bitcoin price action historically. I think something like 70 or 80% of the price movement for Bitcoin over any given period of time actually happens in fewer than 30 days. So it tends to be extremely volatile, and then just not do anything for a lot of the time.
Yeah.
Uh,
Yeah.
but during that scenario where the price gradually moves up and difficulty gradually moves up, that scenario models out the poorest. We'd still be okay, but this strategy in particular benefits from high market volatility. So it was designed based on, modeling and simulation of previous market conditions that we had observed.
Well, I would say y'all's ability to model on the curtailment side bodes well for your ability to model on the Bitcoin-denominated debt side as well.
Yeah, I hope so.
Quite impressed. Guys, I've been talking to Jamie McAvity. He is the CEO of Cormint. Jamie, where can people go to find you?
So our website, we even though we're not a public company, we do publish a lot of information on our website, financials, news, everything can be found there. That's Cormint.com. Our investors and lenders actually can, by becoming an investor or lender, you get access to real-time information about the mining performance. So you can see our real-time hash rate. You can see the current price of power that we're mining at. You can see our cold wallets, and you can see whether or not we're curtailed. So, our investors get a nice experience of watching the mining performance, especially, when it's very windy. That can be fun when we're curtailed because prices are high. I get a lot of text messages saying, "Hey, what's going on here?" But yeah, Cormint.com, and our Twitter is Cormint Inc. My Twitter is @James McAvity. And our Bitcoin denominated notes are going to be open a little bit longer. We're pretty well finished up there. We've raised north of 800 Bitcoin throughout the whole issuance, but we may offer new Bitcoin denominated products to investors. You have to be an accredited investor, and there's a pretty rigorous certification process that we have to take everyone through in order to be compliant with SEC regulations. But now we think it's an interesting product for Bitcoiners, and we're really grateful to all of our investors for supporting us, and obviously for Lee and TBC. We love you guys so much, and the industry wouldn't be where it is without you. So just grateful for everybody, and happy to be fighting another day.
There you go. Thanks for coming on, Jamie. Enjoy New York.
Thanks, Lee.
Hey, it's Amy. Click over here to subscribe. Click over here for more content, and we'll see you next time.